Welcome to the 3 Edge Week in Review for the week of April 10th. I'm Fritz Folts, the Chief Investment Strategist here at 3 Edge, and this week our Week in Review video features an in-depth capital markets outlook from Steve Cucchiaro, the CEO and Chief Investment Officer here at 3 Edge Asset Management. This capital markets outlook was recorded earlier in the week as part of our 3 Edge quarterly webinar for the first quarter of 2023. As always, I think you will find Steve's commentary to be thoughtful and insightful, and hope that it will bring some clarity to this period of heightened economic and market uncertainty. Steve and I will be back next week with another edition of the 3 Edge Week in Review. As a reminder, all of our videos are always available on our 3 Edge YouTube channel. You can simply go to YouTube, type in 3 Edge, and you will see our entire library of video material. In addition, all our written content and much more is available on our website at 3edgeam.com. So enjoy the video. Always feel free to reach out to us here at 3 Edge should you have any questions, and thanks for listening.
Thank you, Fritz. What I'd like to do is start off with a quick review of our discipline approach. This can be particularly helpful for our new clients, but also a quick refresher for our existing clients. And as a reminder, our idea is to blend what we think of as the best of both worlds. The knowledge of an experienced team whose members have navigated a number of market cycles successfully over a long period of time, coupled with a rigorous scientific approach. Our philosophy is that we believe market behavior and price movements are not completely random. Of course, there's randomness in the market, but that they're very much driven by key cause and effect relationships that impact the equity market, bond market, currency market, the commodity market, the gold market, worldwide, and these are all interrelated. And as you see in this chart, we separate all the different relationships and variables that we track and identify in three major categories: valuation factors, which are longer term in nature; global macroeconomic factors, which are medium term in nature; and behavioral factors, which are shorter term in nature. And we know that with behavioral factors, sometimes the markets can act as a herd mentality and ignore the fundamental factors, ignore valuation, ignore what's happening in the economics, just be driven by greed and fear. And so we have a number of behavioral algorithms that are meant to track market behavior. And what we do differently than a lot of other similar approaches is that we notice that when we make them context sensitive and we allow them to vary based on changes in underlying economic and market conditions, we get more robust results. So when we put this all together, what we do then is through our research, we identify and mathematically describe the key relationships, including those subtleties, to capture realistic movements in the real world markets and those nonlinearities that exist in the real world that a lot of quantitative approaches fail to capture. They're much more linear and simple. Once we do that, we translate all those mathematical relationships into algorithms that the computer can understand. Computer model then becomes a model of the global capital markets as an interrelated ecosystem, and that gets optimized 24/7 up in the cloud using advanced machine learning and AI techniques. The result is a laboratory that allows for exhaustive testing and simulation under the widest variety of market conditions and economic conditions. And so in this process, the team is constantly trying to make the model more intelligent. The model is certainly making the team more intelligent, so it's a constant learning and evolving process. So I hope that was a helpful review. Next, I want to turn attention to the great debate that's going on right now in the markets, which is, will there be a recession, a serious recession that's looming in our horizon, or will we get away scot-free and miss a recession and have a so-called soft landing or continue to sail across? So there's a big debate going on. The recessions are called by a body called the NBER, the National Bureau of Economic Research. And I recently met a few months ago with the head, Jim Poterber, and we talked about their approach in analyzing recessions. And they're known to declare a recession often 6 to 9 months after it's already started. And we talked about some of the early warning signs that we use, and he said he'd do some research. Those are interesting, but their mission is not to call a recession as it happens, but that to have a more historical perspective and wait until the data is so compelling that then they can go back in time. So often in the real world, when a recession happens, people don't realize it until long after it started. The other reason why this is so important is that typically it's not a great time to put all your money in equities if you know that following that period a recession is coming. It's often much better to put your money in the market either at the bottom of the recession or as it's recovering. So let's begin and look at the warning signs. The first one has to do with the yield curve slope. And the yield curve is simply the difference between the short-term rate on the left and the long-term rate on the right. In most normal times, the short-term rate on the left in that gray line below is lower than the long-term rate on the right. That's called a normal yield curve. That's what exists the vast majority of the time. And that promotes economic growth and lending in the banking system because banks take money in the short term and lend it in the long term, and they make money off of that spread. When the Fed decides the economy overheats and it's time to tighten, they raise short-term rates so high that they become higher than long-term rates, and that acts as a brake on the economy with the hope of slowing down inflation. And you can see from in a one-year period, it's had a dramatic change from a very steep yield curve, steeper than normal, to now a very inverted yield curve, and one of the more inverted yield curves that I've ever seen. I went back over 150 years of stock market history, and every time in the past so far that the yield curve has been this inverted, there has always been a recession following. So that's a strong indicator. It doesn't mean that necessarily has to happen again, but I would say this is a strong indication pointing to a high possibility of recession down the road. Keeping in mind, there's always a lag between when the yield curve inverts and when the recession comes. Next, credit spreads. Credit spreads are simply the difference that investors need to accept from lending to a riskier company versus the treasury market. The top line shows the riskier companies, the so-called junk bonds or high yield investments. The bottom line are safer investments, investment grade, but not as safe as treasuries. And it's very true, and our model research shows how sensitive the models are, especially to high yield credit spreads. And when credit spreads rise, typically a recession will follow. So right now, this indicator is inconclusive. There's been a lot of fluctuation, but generally sideways. But it's something we're watching very, very closely to see if the recent small uptick in these yields are going to extend to a bigger uptick. It's because bond investors are so sensitive to anything that could hurt the ability of that company to pay back its loan. Next, the Fed balance sheet. I've said this before, and I'll keep saying it because it's so extraordinary, but the Fed printed more money in the last 3 years than the previous 107 years. And yet, when the Fed finally realized that inflation wasn't transitory, it decided to start raising rates, and it declared it's going to shrink its balance sheet, and it outlined a program that's going to shrink it all the way down like that orange line suggests. And it began doing that. You can see the blue line at the top. That's the balance sheet of the Fed. And as it's gone up for the last 3 years, it's created tremendous asset inflation in the economy. Now that it's coming down, it should be worrisome that this is going to reverse that process. It might fight inflation, but it might hurt the economy and the markets. Well, you can see it started down. And then if you look very closely, there's a blip just recently upward, and that was the Fed coming in to rescue when the banking system went into chaos. So it remains to be seen whether they are going to follow their plan or whether they are going to abandon this notion. But never before in history have we seen the kind of contraction that their projections originally stated. So this is something to keep watching. Next, we see another early warning indicator, and this is something that's gotten a lot of interest lately. And these are, is the banking system going to start tightening its lending standards, which is another form of tightening in parallel with and separate from what the Fed is doing. And people are waiting until Friday when the banks start reporting their earnings for any guidance, whether they're intent to tighten their lending standards or not. But even before that, we have some early indication that bank lending is already tightening. And you see this big drop in the right side of that chart. And what that shows is that bank lending is tightened to a degree that's very consistent with past recessions. Next, government debt and fiscal spending. Fiscal policy can add a lot of juice to the economy, and contracting fiscal spending can take away a lot of juice. Well, we've seen these blue lines representing tremendous amount of fiscal spending over the last 2 years. Just absolutely unprecedented and enormous. And this is adding to the debt. And then it looks like 2002 is not going to be as bad, or it wasn't as bad as 2000 and 2001, but still one of the highest amounts of spending that we've ever had, over and above whatever revenues were generated. The orange line shows the interest expense that the government has to pay on the debt. Even though the debt has been exploding, the interest expense has climbed slowly because interest rates up until now have been so low. But it's really easy to calculate with the total cumulative debt being close to $32 trillion and climbing rapidly. And interest rates being in the vicinity of 4%. When that debt gets to roll over, the US government is going to have to pay well over $1 trillion a year just on the interest alone. And this is going to crowd out other possible spending. That plus the gridlock Congress suggests that maybe we will get a reversal of all this fiscal spending, and there might be a tightening, and that could be recessionary. Next, profit margins. There are many people who say, don't worry about a recession. Corporate profits are doing really, really well. And so there's no need to worry about a recession. Well, is that true? First of all, what is true is that corporate profits are doing phenomenally well. There's only one time in history that corporate profit margins were higher. And so it is true that people say corporate profitability is really great. The bad news is that usually when corporate profit margins are either really high or really low, they revert to the mean. They don't last that way forever. There are a lot of natural causes bring them back to average. So we look back in history, and the only time the corporate profits were higher than they are now, ironically, was the summer of 1929, right before the crash of 29 and the Great Depression. The only other time they were close to this high was March of 1937, right before the second dip of the Great Depression, where the stock market fell 50%. So we view high profit margin not as great news that you should be relaxed and fully invest in the market, but it's vulnerable if it comes back to normal. That's not built into the market prices. And then next, we know that oftentimes the stock market leads the economy. And when you see a correction, that precedes the economic growth going down or even negative. And Paul Samuelson once famously quipped that stock market predicts 9 of the 5 recessions that happen. In other words, every time there's a stock market correction, it doesn't mean that you have a recession, but every recession has been preceded by a stock market correction. So we have had a stock market correction. We'll see if it continues. And then finally, others say, ridiculous to consider a recession. Unemployment is so low, it's lower than it's been since the 1960s, and that is true. However, if you look back, this goes from 1950 to the present. These shaded areas are the recessions. And every recession has been preceded by a dip, sharp dip and a low point in the unemployment rate, or you can say peak employment. So this is very much a lagging indicator. And if a recession started soon, it would be very consistent with all the other recessions that they usually start right after unemployment was at very low periods. So in wrapping up, these are 8 key warning signs of recession. We're watching them all very closely. They're all integrated into our models. Some of them are indicating clearly we're going to have a recession, but not all. So we'll continue to monitor this. Next, time to take a step back and look at valuation of the US stock market. And we look at the S&P 500 index. And we've shown this before, but it's important to update this to see if anything has changed. What we've shown is that there's an incredibly good relationship between if you buy into the market when it's cheap versus when it's expensive, and what are the next 10 years of returns that you can expect. So we literally took a snapshot every month for the last 150 years of what the price to sales ratio is for the market. The price sales ratio is an excellent indicator whether the market is cheap or expensive, because it simply takes the price of the market, divides by all the sales revenue that the companies in the market create, and has a ratio. And over the last 150 years, over the life of the stock market in the US, the ratio averages around 1.1, 1.2. When the market's really cheap, you look over to the left, that's the first decile of the bottom 10% of those price to sales ratios over time. And when you're in that decile, the next 10 years, you average 16% a year return. Fantastic. So buying low and selling high is a great strategy. Hard to do behaviorally, but a great strategy. And when you're way over on the right, the next 10 years have been low returns. Well, one reason why we got very defensive at the end of 2021 was we were literally off the chart, 3.2 as opposed to the average 1.1 to 1.2. Some of that was driven by the concentration of tech stocks that naturally have higher price sales ratios. But you can't explain that outrageous price to sales ratio just on the tech stocks. And even at the top of the tech stock bubble, it wasn't anywhere near 3.2. After the big correction in 2022, we're still at 2.3, which is still to the right of the top decile average. So we still say the market is overvalued. Next, now we're going to take a look, rather than the big picture valuation long-term, we're going to take a look at the short-term behavioral picture. Many traders who trade in the short term, they might ignore valuation, they might ignore economics, but they follow price charts and they follow other short-term indicators. And we've been observing this narrowing wedge, or this price wedge, for some time, where every time the stock market in blue goes up and hits the top of that wedge, it seems to turn around and come down. When it hits the bottom line, it seems to turn around and come up. And all these fluctuations have been narrowing over time. And typically, when you see a pattern like that, you might see these fluctuations getting narrower and narrower. And then at the end, there's a breakout one way or the other that's decisive. Right now, we're at the very top of that range. And it was interesting to see today when the inflation report came out, the first reaction was positive, and we started to break right up to that line. And then now the markets have come down a little bit. And so it'll be interesting to see if this is a short-term peak and we come back down again. But something we're watching for short-term behavior. Next, let's say that we break down below that line. That would be an indication that perhaps the next leg of the bear market is ready to happen. So we think of the bear market as starting the 3rd of January, 2022. And we had tremendous profit taking. We had the bull market price momentum broken, and we had a big downturn during the year. And then, as we always do in bear markets, we had a bear market rally that started late in the year. It's continued through recently. The second phase of a bear market typically has to do with more fundamental reasons, like when investors realize that corporate earnings are ready to weaken, that they can't stay so high forever. And so earnings season starts on Friday. Over the next 2 or 3 weeks, we're going to hear lots of earnings reports. And if they're all weaker than expected, and there's some who think they will be, not everyone, then this might be the onset of the next leg of the bear market. The final leg is when you get capitulation at the end, when people say, I can't take it anymore. I don't care what the price is, get me out. Or when they're leveraged and they're forced to sell because of liquidity needs. And that's usually the third leg of the bear market. When everyone's selling, it's good to have some dry powder and take advantage of those low prices. The alternative scenario is not that we continue in the bear market, but that we have what we call an echo bubble. And in history, when stock market bubbles like what we saw in 2001 burst, you don't go down in a straight line, but you have these bear market rallies, and some of them are quite strong. And what happens is psychologically, people get sick and tired of the doom and gloom and the recession talk and the bear market talk, and they have nostalgia for the good old days. And so you see some of the same investments that did well during the bubble start to do well again. And we're seeing some of that. We're seeing Bitcoin rise again. We're seeing tech stocks rise again more than other things. And so it is possible that the echo bubble returns in earnest. And we see another breakout over that narrow price wedge. And we continue to go up a bit more. But it would be more of a psychology move. And because of our valuation work, we don't think it would be long lasting. Gold. Gold, as Fritz mentioned, had a very good quarter in Q1 and the best performing major asset class in Q1. And one reason why is that real interest rates, so the difference between 10-year treasury yield and expected inflation, is starting to come down again, that blue line. As you see over time, there's an inverse relationship between the blue line, which are real interest rates, and they could be measured by looking at the 10-year TIPS yield, and the gold line, which is the gold price. And when one is falling, the other's rising and vice versa. And so we saw gold disappoint a lot of people and just go sideways with a lot of volatility because real rates were climbing sharply, restraining gold from being the inflation hedge people thought it would be. But now the blue line, real interest rates are starting to come down and gold's starting to rise again. And this could be the beginning of another rally. Time will tell. Next, some people think of gold as just short-term insurance, that over time, like over the last 100 years, gold has not performed anywhere near what the stock market has performed. But there are periods of time when gold outperforms. So some people just imagine that it's not a real investment, or maybe you dip in and out very quickly if things get very chaotic. Very few people realize that gold might outperform over more than just a very short period. So we looked over the last 25 years. And in fact, if you had half your money in gold and the other half of your money in the S&P 500 stock market index with dividends reinvested, the half that was in gold actually did better, which is quite surprising to many. I want to turn attention to bonds. A lot of investors' whole investment life happened during this period, 1980 to 2020. A lot of money managers' careers started during this period. And a lot of people started to feel as though this was a normal period for bonds. It was anything but normal. It was the biggest bull market in bonds in the history of civilization. We had interest rates in 1980 very high, coming down with zigs and zags, but coming down pretty much for 40 years. And during that period, if you were a bond investor, you made a tremendous return over and above inflation. You multiplied your money by several times over and above inflation. So that's why it got imbued in so many investors' strategy to have a healthy allocation to long-term bonds as a hedge against stocks. And it worked great for 40 years. It didn't always work great, and we don't think it's going to continue to work great going forward. The 40 years before that, from 1940 to 1980, was a terrible time to be a bond investor. And against inflation, bond investors lost more than half their wealth. And you can think of it as almost a hidden tax where bond investors helped subsidize the US government and the massive debt that had accumulated during World War II by accepting a rate of return below inflation. And we hypothesized that 2020 was the end of the great bond bull market, and people should be more fearful of investing in long-term bonds. And sure enough, in 2022, long-term bonds had their worst performance since 1754. That sounds extraordinary, but true. And compared to the terrible record from 1940 to 1980 in the blue line, bonds are actually even underperforming that terrible record. It won't be a straight line down. Bonds could rally here for a bit, but we think any rally in the bond prices or any drop in the bond yields is just a correction in what might be a longer-term bear market. We're going to have more and more government debt. We're going to have more supply of bonds looking for buyers. A lot of the natural buyers who are supplying and investing in our bonds have been starting to exit the market. So this could be not the great time to put all your money in long-term bonds for the long term. We've showed this chart before, and we'll show it again. It's seasons of the market. It's a very simple way to try to capture what's happening in the market cycle. And we draw an analogy between market cycles and the calendar year seasons. Winter is like an economic downturn. Spring is like a recovery. Summer is like an overheated economy. Fall is like a credit contraction. And we're operating with an overheated economy with inflation out of control, unemployment at many decade low period. And the Fed finally belatedly agreeing that they needed to do something. So they started tighten up. And that's when we start to enter the fall. Optimistic investors feel that we're just about done with the credit contraction phase, in that we're going to quickly skim by the economic downturn into recovery, and it's time to buy stocks again. But a word of caution, the credit contraction could still be in the earliest stage. The Fed might not be done raising rates. They might not be done shrinking the balance sheet. Then on top of what the Fed is doing, we might have a slowdown in fiscal spending. We might have bank loan tightening really start to crunch the economy. We might have consumers who have been spending like there's no future because they're coming out of COVID and they want to do revenge travel and revenge spending, starting to tap out their credit cards. And so the credit contraction might not be near the end, but might just be getting going. And that would produce a more serious recession. So word of caution. To summarize, we are cautious in equities, generally speaking. The only equity index that remains positive, but not as positive as just last month, is the Europe. And Europe has been outperforming. In the fixed income, we're staying away from credit, which is lending to companies, because that's not what you want to do if a recession comes. So we do think there's enough of a chance of a recession to be cautious. And we like tips of Treasury inflation protected securities because we think the market is underestimating future inflation. We're very favorable to short-term, very safe treasuries, and we're favoring 6-month duration, which not only has higher yields, but gets us out of the time horizon of when the debt ceiling might cause a real problem. And then we prefer real assets over fixed income. We know that the Fed has been printing money out of thin air for quite some time. It might do that again if there's another downturn. But you can't print real assets. You can't print real stuff, real commodities. And gold acts as a great hedge against future money printing by the Fed. So with that, I'll turn it back to Fritz.
Excellent. So that brings us to the top of the hour, which is when we're scheduled to end. And so just to be respectful of people's time, let's wrap it up there. I want to thank everyone who took the time to participate in today's webinar. Thanks to our clients for your continued confidence in our firm, particularly during a period of heightened uncertainty that we're experiencing here. And lastly, always feel free to reach out to us at any time with any questions or concerns or anything you want to know about the market. Always glad to hear from clients. So on behalf of Steve and everyone at 3 Edge, thanks for listening.